Cash out refi versus HELOCs. Which one is better for your real estate investment? That's the topic for today's episode. And without further ado, let's dive in. Hello everyone and welcome back. For those who are tuning in for the first time, this is your channel for real estate education. Now, I decided to make this episode because I've been getting a lot of questions about real estate or the use of cash out refi and which one is actually better for real estate. So I decided to create this episode to help you answer all of those questions all at once. And the answer that I have for you is it depends. It all depends on what you're trying to achieve, and it also depends with what you're more comfortable with using as a collateral. So let's say, for example, and we have cash outs, refi, and then you have HELOCs, right? So on the cash out refi side, what you use as a collateral is any property you have. It could be your home, it could be your rental, right? So it's any property. And when it comes to a HELOC means home equity line of credit. What does that mean? It means that in order for you to be able to take money out using a HELOC, you are actually using your own home. So you have to use your home, and not a lot of people are actually comfortable using their own home as a collateral, because that means, what if you default on a payment? You can actually lose your home. So you have more skin in the game on this one. But for this, yes, I know you work really hard to acquire that rental, but you might be okay at the end of the day because you still have a home, right? So that's number one. Then the second one, is with a cash out refi, you get a lump sum out of it. So it's like a mortgage that you're actually putting in. You put your house or your property as a collateral, and all of a sudden they give you $200,000 right from the get-go. And you have $200,000 that you are responsible for repaying, and the payments are due immediately the following month. Now, if you were to use a HELOC works like a credit card. So let's say they give you a line for $200,000, but you don't have to use all $200,000. It's literally like a credit card, only it's backed against your home. Now, so you have $200,000. Let's say this month you wanted to use $40,000 out of it. You use $40,000 because you saw a house that works out, so you take $40,000 out. Then you put that money as a down payment for your investment property. You let it go for a couple of months, but in the meantime, you're only responsible for repaying $40,000. So again, it goes down to, it all depends what you're more comfortable with. Do you want to be responsible for repaying $40,000 only, or do you want to be responsible for repaying $200,000 all in one lump sum? You have that cash readily available. Here, it's sort of like available on paper, but you still have to take it out. So that's one. The second one is that the interests are very variable. So for example, with a cash out refi, you get a fixed rate. It's literally like a mortgage. So you have fixed. It's fixed for the entire 30 years or 15 years, whatever your term is. But the interest rates on the HELOC, it's variable. It's like a credit card. It varies depending on the market. So if the Fed comes in and say, you know what, we're raising interest again this quarter, guess what's going to happen to your interest rate here? It's going to go up according to the market. It's the same thing with the credit cards. And I'm sure you've seen it before. You have a credit card that you got to approve, and all of a sudden the Fed announces something and you get a letter in the mail saying, well, because the prime rate went up by this much, we have to increase your interest rates by a certain percent, right? And the same thing happens when the interest rates go down. So they could lower your interest rates, but they don't necessarily do it. You actually have to call the bank and ask them to lower the interest rates. So here you have no control, so to speak, over the interest because it changes depending on what the market dictates. But the good side of it is that you're not responsible for a big chunk, but you still have access to the capital. Let's say in another year, you want to take out another $400,000 out of that HELOC, but then you're subject to pay interest on that date and time. And over here, when you actually took the interest early, you were subject to the interest rate at the time, but if for whatever reason the market changes, this debt also is subject to the new interest rate. So again, completely up to you as to what you prefer, right? Now, the next thing is how much in an LTV you get, right? So typically with a cash out refi, you will get what they say a 75 LTV, meaning you have to put 25% down. Why? For the same reason I said above here. You can do a cash out refi on any property. It can be on a rental, it can be in your own home, but the assumption is you have less skin in the game. And that's why in order to make you, in order to force you to have more skin in the game, you're gonna have to put more money down, because otherwise you wouldn't walk out of it so easily. That's why they no longer do 100% finance, because if it doesn't work out, then you can just simply walk out of it. There's nothing that you put in of your own money. Here on a HELOC side, they actually have a higher LTV. It usually starts around 80 LTV, depending on your credit and many of the other factors. And then that means that because they know that this is your home, you have less of a chance of walking out of this loan, because it's your home. You're gonna try to do whatever it takes to make this deal work out, because otherwise you'll be homeless, you'll be on the street, and that's something that you don't wanna do. In essence, it depends on what you're looking for. Do you want more money out of that one property? And if so, are you willing to put your home for it? Or are you okay with getting a 5% less on that cash, but you're putting a rental and not your home in particular? And then the next thing that you will want to consider is fees, right? So the fees here, because I mentioned that this is treated as a mortgage, guess what you're going to have in a cash out refi? You're going to have mortgage origination fees, and you're also going to have closing fees. You're going to have to add something between 1 to 6% on fees that you're going to get out of it. And here, because this is treated like a credit card, they might not be application fees or closing costs and stuff like that, but you will have to pay fees, kind of like a credit card, a membership fee, a maintenance fee, a processing fee every time you take money out of it. So these are also some of the fees that you might want to take into account. How often are you going to take money out of this HELOC? Because every time you pull money out, there's a fee that you're going to have to be responsible for. And because it runs like a credit card, you also have to worry about keeping it active, right? So let's say, for example, I'm sure you've seen instances where people have a credit card and then they stop using it for 3 years, and all of a sudden the credit card company either lowers your credit limit, which hurts your credit, or just simply kills your credit card, right? You don't have it active anymore. They cancel it because it has been a no use for the last 2 years or so. It's the same thing with a HELOC. If you don't use it, you lose it. So you have to take some money out of it whatsoever. And so you can't just simply have a HELOC for $200,000 and never use it. You have to take money somewhere along in the equation, just so they can see that there's action that is happening. So if you're the kind of person who maybe forgets about things and doesn't stay on top of stuff like that, you don't want to go through this whole process, pay for some fees, application fees, and then have them sort of like take it away from you because you're not using it. Here, on the other hand, because it's fixed, it acts like a mortgage, you have this account open for sometime between 15 or 30 credits, but then you have a lump sum. Would you be responsible enough to be able to manage that lump sum and invest it in something that's going to give you cash back, and not let the emotions drive you away and then just spend it on whatever it is that comes your way, and still have to worry about repaying this loan? So that's basically what it comes down to. Somebody also asked me about whether it's easier to get one or the other. I don't know how to answer that question, because again, it depends on a lot of factors. It depends on your credit. It depends on your debt to income ratio. Let's say, for example, getting a HELOC is actually easier. I will be lying, because even though it's your home, you might have such a low credit or such a high debt to income ratio that the banks might not even willing to lend you anything. And then in the meantime, the person who has a much better credit, the person who has a much favorable debt to income ratio, then all of a sudden you get approved for a cash out refi. Because I've seen it all over the internet. Some people claim that it's easier to get a HELOC. Some other people claim that it's easier to get a cash out refi. So whether you get approved for a cash out refi or for a HELOC, it all depends on your profile, how high your credit is, how responsible are you with money, how high or low is your debt to income ratio, and all of that plays into the deciding factor, or the deciding formula, the decision formula, is whatever is it that they want to call it, that these lenders have to decide whether you get a hold of that money or not. And then the last factor to consider will be time. What's the timeline? So typically, when you have your own home, because they already know this is your home, you can actually get a HELOC right away. You can close on a home, let's say last month, and you all of a sudden you realize how much you want to take out, then you can actually apply for a HELOC right away. Versus a cash out refi, that you have to let the home sort of like season with you. If you recently bought a home, some banks require that you own it to 6 months, some require that you have owned the home for at least 12 months. So the seasoning plays in a big factor. Although I kind of think of this to be like some sort of like cash 22, damn if you do, damn if you don't, because yes, you have to hold the home long enough in order to have enough equity for you to be able to go to the bank and request some capital. But how much equity do you think you can possibly include or bring up as soon as you buy a home? If you bought a home last month, chances are you haven't even made your first mortgage payment, which means all you have left was the 20% or the 5% that you put into equity. And most lenders require you to have at least 20% equity, so they're willing to lend you against 80% of what you own. So what a lot of people do is that they force the appreciation. That's where the flipping comes in, right? You come here and you start tearing down walls and make the house pretty. You put the granite countertop and stuff like that. Now, that's a little bit risky if you plan to do that, because one, you need to assess whether the neighborhood will actually see value in you adding a granite countertop. It also depends on how well you manage a budget, how well you manage a contractor, and whether you can actually finish a project on time. So if you don't really have any experience flipping houses or renovating houses, I don't suggest that route. But assuming that you have to force the appreciation and you want to bring up the equity of that property, a renovation will probably take you at least 2 to 3 months to do. So even if you wanted to take a HELOC a month after you close on your own home, you still cannot, because you're waiting to force the appreciation up in order to bring the value of the house up so you can take a HELOC out of it. And maybe whatever is it that you get out of it is only a couple of thousands. Versus here, if you've been holding a home under your name or under your LLC name for 6 to 12 months, you will most likely have accumulated enough equity over this period of time. And then if you decide to make some cosmetic upgrades, that's different from having to renovate. If you make cosmetic upgrades, you can still force the appreciation. That doesn't mean you have to tear the entire house apart and flip it around. By changing doorknobs, maybe window accents, maybe fixing the water heater, like putting a new water heater in there, that will automatically bring the value of the home up because you're having newer appliances, so to speak. So definitely something that you want to consider in mind. And last but not least, the HELOC versus cash out. For HELOC, you do not need an LLC, because why would you have your own home under an LLC? And on a cash out refi, you can either close it under your name, or depending on the bank, if you're doing a commercial mortgage, most likely the requirement is that you do the closing on an LLC. So that's it. That's basically all I have for you today. I hope you found the content valuable, helpful, and hopefully this really answered all of the questions that I've been receiving over the months since the first episode that I post. And again, as usual, if you know of somebody that you think is gonna find this information valuable, helpful, feel free to share the love and send this video their way. And as usual, do not forget to hit the like button or subscribe. And again, if you are interested in mentorship, feel free to visit the website or just shoot me an email, and it's right here. And I will see you guys in the next episode. Bye.